If you keep a lot of cash in or currently save into a traditional checking or savings account, you are giving up on free money. So let's talk about the best places to save your cash right now. It's first important to remember that just sitting on cash will not build wealth. Cash is expected to be worth less and less each year with inflation. If you really want to turn your income and savings into wealth, you need to take your cash and buy assets with it. That could be owning stocks. That could be owning real estate. It could be investing in yourself to grow your income or start a business. But you will not build real wealth by just sitting on cash. When we're talking about cash accounts today, I'm thinking more along the lines of you might have an expense over the next couple of years, maybe a home down payment, maybe a car payment, renovations, maybe you're gearing up for retirement and you want to have a stockpile of cash to live on and implement some tax strategies early in retirement. Think about these accounts are best suited for when you're not sure exactly when you need the money, but you know you'll need it sometime over the next couple of years. So the first place to save cash is a simple high-yield savings account. Now these are generally going to be more like online institutions rather than your traditional brick-and-mortar bank. Right now, high-yield savings accounts are paying between 4.35 and just over 5%. And you have some great options from places like Amex, Ally, Discover, Capital One, SoFi, Betterment and Wealthfront, CIT Bank, UFP Direct. There are some great options for these. So a high-yield savings account traditionally is a great spot for your emergency fund, right? Think about that 3 to 6 months of living expenses you have saved up just in case something bad happens. But it can also be a great place to save this extra cash and just put some money set aside when you think you'll need it sometime in the near term. It's important to remember that high-yield savings accounts, that interest rate will fluctuate. A few years ago, these accounts were paying basically nothing, and now they've ramped up to paying this 4.5% to 5%. Who knows what the next 5 years will hold, which again is why high-yield savings accounts aren't generally a long-term place to hold money. It's just a good spot to have it for the short term until you need it. High-yield savings accounts do have FDI insurance coverage up to that $250,000 number, and as well, they're fully liquid. You can access the money anytime you want or need it, which is why they're such a great option for an emergency fund. If you're looking for an option that has a guaranteed rate of return and is within the banking ecosystem, then you're looking at CDs. CDs right now from big banks are paying generally around 5 to 5.5% for a 1-year CD. But remember, you're getting a little bit more potential interest on those, but you're giving up liquidity. If something happens and you need the money from a CD, you'll have to redeem it, and that's usually going to cost you 1 to 3 months of interest payments. CDs, like high-yield savings accounts, have FDIC insurance, and they are subject to state and federal income taxes. Another great option are I-bonds. I-bonds are inflation-protected bonds backed by the U.S. government. They have two components to them. They pay a variable rate of interest and a fixed rate of interest. The variable rate of interest will adjust every 6 months in May and November, depending on inflation. That's how it protects you against inflation. The fixed rate component is a rate that you get for the life of the bond, which is 30 years, when you're buying it. Right now, I-bonds are paying 5.27%. And of that, 1.3% is fixed. That means that you're going to be beating inflation by 1.3% when you buy I-bonds right now, which is great. I-bonds haven't had this much of a fixed rate since 2008. Another great component of I-bonds is they are state income tax free. There are, however, two key issues that you want to be aware of before you look at parking cash in I-bonds. The first is that there's a limit to how much you can buy. That limit is $10,000 per year per social security number. So I could buy $10,000, a spouse could buy $10,000. If you have a business or you own a trust, those can buy $10,000. There is a way to get an extra bit of money in them, and that is through your tax refund. If you do get a tax refund, you can put $5,000 a year from a tax refund into I-bonds. So you can potentially get $15,000 into them. Now, whether or not that $15,000 max is a right idea for you will depend on your situation. For some people, that might be the most that you're able to save. So great, it could be putting money into I-bonds. For other people, if you have a higher net worth and income, I-bonds won't really move the needle enough, and it's just having to open up another account and a hassle, so it might not be the best place depending on your situation. A second issue is liquidity. I-bonds, again, are supposed to be a 30-year long-term bond. You cannot redeem them within 12 months. If you redeem them between 1 year and 5 years, there'll be a penalty of the last 3 months of interest. Now again, when you look at the fixed payment and beating inflation and that inflation hedge and no state income taxes, they still can be a great place to park some money, thinking for this 2 to 4 year time period, earn a little bit more interest than high yield savings accounts have, and state income tax free. So take a look at your situation. I-bonds could be a good place for you to put some money. And now on to my favorite place right now to save cash, and that is Treasury Bills. These are also known as T-bills, and they are short-term government bonds. So essentially you're loaning your money to the US government, and they'll mature in less than a year. These are of course backed by the full faith and credit of the US government. So in the investment world, we call this the risk-free asset. It's what every other investment is compared to. If I can get, which currently T-bills are paying 5.25% to about 5.4%, depending on the range within a year of maturity. If I can get this 5.3%, let's call it, guaranteed by the US government, that's called a risk-free asset. Everything else I compare what my cash can do, I'm comparing it to this guaranteed rate I can get. T-bills are great because they're state income tax free as well, and they offer great liquidity. Unlike, say, CDs or maybe I-bonds, T-bills are very marketable. There is always a market to buy and sell T-bills. So if you're holding T-bills because you're not really sure exactly when you need the cash, but you want to get the most return on your cash possible, if something changes and you need the money, they are very liquid. You can always go online and sell T-bills. Now, the way you buy T-bills are really two options. One, you can go into treasurydirect.gov, which is the same place you can buy I-bonds, or you can go into your brokerage account or your IRA and you can buy them through a mutual fund or an ETF. Two great ETFs I like have the ticker symbols SHV, that's from iShares, or BIL. Both of these, when you're getting any type of ETF or mutual fund, the benefit of those might be that they're constantly maturing. You're buying a basket of T-bills as opposed to just one, and as some of them mature, that fund manager will just go ahead and buy new ones. So there's constantly rolling over and buying new T-bills within that account. If you don't want to have to own multiple T-bills or go and deal with treasurydirect.gov, which is a little bit of a clunky website, that's a great option as well within your current brokerage account. Thanks for watching this video. I'm Peter Campbell, the lead advisor at Bull Oak. We're an independent financial planning firm based in San Diego. If you have any questions or you want to learn more about how we work with our clients, check us out at bulloak.com. Thanks.